Welcome back to Morning Trade Live. It is time now for the big picture. Let's welcome in the team from Charles Schwab. We have Nate Peterson, Director of Derivatives Analysis, Schwab Center for Financial Research, and Mike Townsend, who is the Managing Director, Legislative Regulatory Affairs at Charles Schwab. Mike, let's just start with you. We're less than 14 hours away from this potential government shutdown now. What should investors be paying attention to? What kind of impact is it going to have?
Yeah, Sam, it looks like we are headed to a shutdown. And I think the real question that everybody has is how long is this going to last? The shutdown starts at midnight tonight. And the administration has pretty wide latitude as to what can be affected. They control sort of who is an essential worker and what kind of services will be impacted. So, I think it's going to be really critical to figure out how long this is going to last, because if it's 7 or 10 days or something, probably not a big impact. But longer than that, you start to really impact the economy and potentially the markets. And obviously, Sam, for our world, one of the biggest things that everybody's watching is the fact that the Bureau of Labor Statistics has said that they will not publish their data, particularly on the jobs report, which is scheduled to come out on Friday. If the shutdown lasts longer, that would affect CPI data in the middle of the month. And so I think, heading towards a Fed meeting at the end of October, you're looking at a lack of data to make decisions. And I think that's going to be potentially very impactful.
Yeah, and of course, those data prints are very much the make or break as far as the dual mandate as to what the Fed does next with regards to the next steps. Nate, I'm just wondering, as far as the market reaction to this today, a bit of a caution as we approach this looming deadline. What do you make of what we're seeing as far as the reaction in the markets today?
Yeah, and I'd say it's relatively benign, relatively muted. I think the market has been through this playbook around shutdowns, 6 times over the past decade or so, maybe the last 15 years. And it's always, even if we've gone into a shutdown, then we've ended up, it's being resolved relatively quickly. The economic impact or the corporate, the impact to the bottom line of corporations, relatively muted. It's not good for, of course, the furloughed workers, et cetera, or the disruptions to data. But, if you look, Sam, at what the market is kind of the signal that it's sending, I mean, you just mentioned CoreWeave's, announcement with Meta, NVIDIA, new all-time high on an intraday basis here that it hit. That AI secular growth story is at the backdrop. These types of new announcements continue to send that signal of where the AI story stands in terms of, inning 4, 5, 6. We don't really know. Then you're getting out of, bearish seasonality as we move into Q4 here. You look at EPS growth revisions estimates. They've been very healthy, if not trending higher, looking for double digit this year, double digit next year. Then you could have the potential for performance chasing. And if you look at what happened last week, for example, we got a little bit of a wobble on the AI story around that circular financing. Oracle got a sell rating, 175 price target. The S&P pulls back to its 20-day SMA. It bounced right off of it on Friday, and it's seeing some of that basically classic uptrend behavior. The S&P 500 has only traded below its 20-day SMA for 3 days since April. And that just tells you how strong this uptrend is. So if you're looking at the market, you're concerned about a shutdown, or you're concerned that valuation is too high, I get it. But do you want to fight the trend? Do you want to fight a relatively accommodative Fed? Do you want to fight bullish seasonality, the potential for performance chasing? So after we get past this government shutdown, at some point it will be resolved. We're going to be turning our eyes to earnings season, which starts here in a couple weeks. And there's a lot of forces that feel like until we start to get some technical damage, let's get a couple days closing below the 20-day SMA, there's a lot of forces that just start driving this market in this steady uptrend.
Yes, I mean, you've seen the Wall Street banks continuing to up their year-end targets. And I mean, I think it was Goldman just in recent days who was sort of suggesting that they continue to see the equity rally extending and would be buying dips at sort of any opportunity. So, I mean, when you have that sort of thinking, it's, obviously interesting to see, how the markets are reacting right now. As you say, fairly muted. Mike, I just want to ask you, with respect to what we're seeing here with sort of the finger pointing coming from both sides, the Republicans, the Democrats, there's obviously been a big question around whether we could actually see firings as a result of this. I'm just wondering, as far as the market reaction and some of the questions, I mean, we've been talking about bond vigilantes lately, and fiscal irresponsibility. How the markets would sort of react to something like that if we were to indeed see an episode such as firings.
Yeah, Sam, and picking up on something Nate said, I mean, I think it's right that, typically markets have not reacted to government shutdowns. In fact, the S&P 500 has actually gone up in the last 5 government shutdowns. I do think there's a little bit more worry this time about this situation. And you referenced one big factor, which is that the administration has been openly talking about using this as an opportunity to fire employees rather than just furlough employees who aren't essential. I mean, those furloughed employees, get their jobs back when the government opens up, and they usually get back pay. If they're going to fire employees, that's a different dynamic. And that's, again, part of this widespread effort to reduce the size of the federal government. I think the other aspect that is concerning, and probably more concerning to the bond market than the equity market right now, is this sense of just kind of general dysfunction in the political system and around fiscal discipline. And I think the bond market is growing and has been showing signs all year that it's not happy with the direction of deficits, with the direction of the federal debt, and a lack of focus on that. I think this is just another data point saying, that the government just isn't in a place where it can kind of get its fiscal house in order. So I think that's what I'm going to be watching over the month of October, particularly if this lasts for more than a couple of weeks. And I do think it's possible it could last most of October. Then that's what I'm going to be really watching is how is the bond market reacting to this kind of another evidence that the government just can't get its house in order.
Okay, yeah, keeping an eye on the bond market. I mean, if it does certainly drag on, you wonder if there would even be a Fed meeting. But I suppose let's not jump the gun just yet to see how things play out. Really appreciate both of you for coming on today. Nathan Peterson, Director of Derivatives Analysis, Schwab Center for Financial Research, and Mike Townsend, who's the Managing Director, Legislative and Regulatory Affairs at Charles Schwab.